Welcome to The Investing Show, where we discuss the news that matters to investors and get investing ideas to help you make more of your money. I'm Simon Lambert from This Is Money. Joining me here in the studio, I've got Richard Hunter, Head of Equities at Hargreaves Lansdown.
Oh, Simon.
And Nick Moose Batsford, CEO of Tip TV.
Simon.
Coming up later on today's show, we've got Tom Beckett, Chief Investment Officer at Sigma Investment Management. He's going to talk to us about the way the year's panned out so far and where to invest in the coming year ahead. But first, a quick look at some of the news that matters. Now, since the last show, we've seen some terrible news with the attacks on Paris, and the market's reacted to that in the past few days. What's the reaction been, Richard?
It's actually been quite muted on this occasion. I mean, despite the human tragedy, which can't be avoided, when things like this normally happen, the market has to react immediately with obviously its financial hat on. The slight difference with this one was that market participants had the entire weekend to start thinking about what the implications might be. So what we actually had on the first working day, back on the Monday, was a fairly restrained reaction, probably an initial dip, but the market recovered a bit later on. We had exactly the same in the States. In the meantime, what did then happen, with the sentiment part of it being out of the way, was the kind of stock specifics that you would imagine would happen. So there was some pressure on the airline stocks, on the cruise stocks such as Carnival, on a couple of the hotelier stocks such as Intercontinental, with those tourist concerns around. And certainly in the earlier part of the day, there had been some movement of funds into what you might call haven stocks, so stocks and commodities. So the US dollar was a beneficiary, as was gold to begin with. So that in turn impacted positively on a couple of the mining stocks such as Randgold Resources. And then of course after that, what the market then thinks about is in terms of the wider implications, what might happen. So the day after, we saw a subsequent bounce in some of the defence companies, the Rolls-Royce, despite their recent tribulations, and a 25% dip in the share price over a week, and the likes of BAE Systems, British Aerospace as well. So I think it's fair to say that quite apart from the human tragedy part of these events, investors need to be, if possible, probably pre-thinking about what kind of stocks might be affected by what kind of attack, should God forbid another one happen.
And when we look at a situation like this, how long do the effects tend to stick around if we do hopefully see a one-off event?
It really depends. I mean, obviously the first day or two, investors are going to be on edge. Then of course financial memory becomes very short, so it can well be that after just a few days, in the absence of any further news breaking, that markets are pretty much back to concentrating on the sort of factors that they were concentrating on before. But of course, given where we've been this year, I think if there were to be anything negative coming along in the nearer term, markets are nervous enough to have to be reacting to that negatively, because sentiment, as we've seen so many times in 2015, has oscillated between positive and negative. And whilst it's been positive so far, it's also possible that when we do have a risk-off day for whatever reason, a negative market day, that investors decide to use the atrocities in Paris at the weekend as an effort to push the market down as well.
And I mean, the market has been sold off actually before those events. I was looking at it last week, and Nick, you're a trader. I was looking at ex-trader. I was looking at the RSI, and the RSI was down below 30, which is considered to be oversold territory, isn't it? And once a market falls down below that 30 level, traders look at that and think it's due a bounce. That's true, isn't it?
In the simplest form, overbought, oversold. RSI is a momentum reading. A lot of technical analysts use it. And that is an area that's deemed to be basically a market has moved too far one way. You should never ever trade on that indicator alone, though. I've seen too many people lose too much money. But again, it is a gauge of exactly where your filled position is.
And I mean, with that sort of technical analysis, you alluded to it there. It's a jigsaw, isn't it? Is it oversold? how does it look in terms of moving averages and also the charts, but then also looking at the fundamentals as well?
Well, I think the really good traders that I came across mix the fundamentals and the technicals. The fundamentals should tell you what to buy and sell. The technicals should tell you when to buy and sell them. So a combination of the both. I think just purely being a technical trader or being purely a fundamental trader, you're not getting the best of both worlds.
So do you think that, having seen a sell-off already, do you think we're being set up for a Santa rally?
Well,
nearing December, have to ask the question.
I think this, in terms of the FTSE 100, this psychological round number of 6,000 is the key component. And we've had some technicians on one of the shows that we run, and they're saying that 62.50 again is a level of resistance, i.e. where the sellers appear to be coming in. I think if we can maintain above 6,000, get above 62.50, the field position would be much stronger from a technical perspective.
It's going to make a huge difference, isn't it, to how people see the year in investing terms when we come round to those sort of last 2 weeks of December, whether we're still knocking around 6,200, 6,300, or whether we're at 7,000 for the FTSE 100. It's going to be a difference between a good year and a bad year.
Yes, it will. I mean, at say 6,100, the sort of levels the FTSE's been at the last couple of days, it's down about 6% for the year. That's just on a headline basis. So if you, over the full year, let's just say the FTSE 100 has been averaging about 3.5% in terms of dividends, that will nonetheless mean that we'll finish down on the year. I think when we look back on 2015, if we were to finish flat or down 1 or 2%, that would be a fairly creditable performance given some of the headwinds that we've had this year. And hopefully we can return to the sort of growth we weren't necessarily seeing in the last quarterly reporting season, where although most companies were beating expectations, much of that was down to cutting costs as opposed to growing revenues.
Nick, one thing you were going to look at is certainly something that's been a headwind this year, isn't it? It's commodities.
Well, commodities, this is sort of my press review, if that's the right word. David Buick is a city stalwart. He sent out a note last week highlighting the Bloomberg Commodity Index, which was set up 15 years ago at a benchmark reading of around about 100, saying just before the financial crisis hit the top gear in September 08, it stood at 238. So everyone was obviously making decent returns. The index, as of the last week, stood at an all-time low of 82. This basically shows that, for him, uncomfortable alarm bells were going for the mining companies. Break even, he's suggesting, is now around about 120. Is there worse to come? So that was his headline. Now, Merrin Somerset Webb in the FT basically was referring to some essays that are about to be issued from Marathon Asset Management. And she basically made these points. China's GDP is slowing, we know that, and it may have stalled. Without China importing 50% of every commodity produced, prices cannot rise, profits cannot rise, and share prices cannot rise. That was the strong influence of China. This year, copper, palladium, iron ore, all down circa 20%, nickel down 30%. Headline commodity super cycle is dead, null and void. Sentiment towards commodity investments is an extremely low reading. I think we all know that. Annual mine production rose by 20% a year from 2000 to 2011. Mining capital expenditure rose from 30 billion a year to 160 billion a year during this period. So what next? Investment gets pulled out of the sector, production falls back, so supply is constrained and prices then rise. And there's a suggest something may now be going on in favour of the mining sector. Glencore announced production cuts for zinc and copper. Freeport is cutting too. The conclusion, new capacity commissioned in the boom years is still coming basically on stream, but the bottom won't be that far off. Watch for mine closures, more mothballing and cuts to capital expenditure, then start buying back into the miners.
Trying to spot that bottom is exceptionally difficult.
It's the most difficult game in the world.
Talking about
picking tops and bottoms.
Yeah.
But again, I thought that just put a little bit of balance. You know, we may not be that far away.
And there was an interesting comment from the chief exec of Rio Tinto very recently, saying that because there's been a lot of debate around whether China's GDP growth is 7% as they're reporting it, or whether in fact it's nearer 3.5%, 4%, as seems to be the case from a lot of companies doing business out there. And the chairman of Rio Tinto was saying that they'd basically, as far as they can, had commissioned their own estimation of what Chinese GDP might be, and he's sticking, although he would say this, wouldn't he? He's sticking with a figure of nearer 7%, which obviously is rather better news for miners as well, or would be.
Well, all those concerns about the global economy mean one thing, basically. Inflation's low. We've just seen the third straight month of deflation at 0.1%. And the Bank of England last week released its inflation report, which hints that rates might not be going up early next year, as we were thinking, and maybe not even the middle of next year, but maybe the end of next year. The guessing game over interest rates, are we any closer to really knowing an answer on this?
No, I think the place to look is probably the sort of the government bond sort of area. They're probably guessing as well to somewhere like the middle to the end of next year. There just don't seem to be any inflationary pressures coming through. Even if you strip away the obvious readings of that index in the form of oil and food, we know there's some fairly serious deflation going on in both of those. There's been a very slight uptick in what you might call core inflation, but certainly nothing to worry the Bank of England just yet. So that would be yet another reason to suspect that an interest rate isn't coming anytime soon.
Do you expect one?
I think we're a long way away from interest rates going up in the UK. I think deflation is a bigger problem than the central banks are suggesting at this juncture.
I must admit, my suspicion is that before we manage to raise interest rates, something bad will happen, and that'll kick it back a bit further into the long grass. I mean, the one good thing I would say about interest rate expectations moving backwards is that this now means that those record cheap mortgages that were on offer earlier this year, and the rates had then started to rise, are now back on the table. So if you did miss out on fixing for 5 years at a very low rate, and you fancy having another crack at it, now is a very good time to be looking for those mortgages, especially because banks and building societies are looking to fill their end of year targets, and so they're offering some very, very competitive deals. Coming up after the break, we've got Tom Beckett of Sigma Investment Management to talk to us about where he likes to invest at the moment and where he doesn't like. Join us then. Welcome back to the Investing Show. Joining us here, we've got Tom Beckett, CIO of Sigma Investment Management. Tom, welcome to the show.
Thank you.
Or welcome back to the show, I should say.
That's a good point, well made, thank you.
Yes, I was looking through it. I think it was last Easter time, actually, that we had you on before.
Excellent.
And obviously, not much of the year unfolded at that point.
No.
We've had quite a bit more now. Have things unfolded as you suspected?
Well, I hope no one remembers what I said last time, because certainly I don't, but it's been a year when it's been difficult to make money, I think, in truth. And I think a lot of the things that people expected to happen, things like interest rate rises and the global economy to keep on improving through the year and corporate profits to come through strongly, have been somewhat illusory. Certainly with regards to interest rates, we find the somewhat backtracking Mr. Carney once again doing his favourite trick and trying to put off analysts on interest rates now for quite a long time again. And you know, we might be coming to the point where they lift off in the US, and we think that's going to happen in December, but the UK interest rate hike still seems some way out here. So I think that's caught people off guard, and that's really shaped the way that markets have performed in the UK. I think elsewhere, you know, certainly if you look at the FTSE 100 as quite a good barometer of the global economic health, actually it's tracked that quite well so far this year. Everyone got off enthusiastically at the start of the year. I think actually the market was peaking about the last time I came in here, so apologies if everyone seemed optimistic at the time. And then we had the traditional summer slump, but I think this summer slump really caught people off guard more than previous ones had done, actually. And I think there was a lot of concerns over China in particular. Those have now started to dissipate again, but really the FTSE has tracked that swing in economic activity and sentiment, so a good start to the year, really a very shaky and weak summer. And I think broadly, you guys were talking about a Santa rally, I prefer the term Rudolph rally, and I think markets might now be setting themselves up for a decent end to the year based upon economic fundamentals and the hope that next year will bring another resumption of strong corporate profits growth.
So when you're looking, you know, as a chief investment officer around the world at places to invest, what do you see that you like at the moment?
Well, I think markets are actually very, very interesting at this point in time, because it strikes me that you have a very polarised market opportunity. On the one side, you have the stuff that's done very, very well in the last few years. Anything which is dull, defensive, has got a certain amount of security to it. Those assets have performed incredibly well in the last few years, and if you've held those assets, you've really done quite well. On the flip side of that, and one of the reasons I'm optimistic, is actually you have certain sectors, regions, companies, assets which look to me to be on a relative basis as cheap as they ever have done in their history. And I think really this success or failure of the next few years will be defined by your willingness to make difficult investment decisions now. Ultimately, people are very, very scared about doing so. But if you, like I do, believe that we live in the world that we have done for the last 6 years of moderate growth, moderate to rising interest rates, moderate inflation and moderate corporate profitability, I think actually next year and the year afterwards could see some quite vicious rotation from those assets that have done well into those assets that have done poorly. I heard you talk about mining companies earlier, but at some point in the next few years, buying into sectors like mining will deliver you a lot of money, and I think people are ill prepared for that at this point in time.
Would that sort of extend in terms of valuations or sentiment to some of the other sort of sectors that have been struggling, such as the banking sector, for example?
Yeah, definitely. And I think, all of us in this room have worked the last time when the last interest rate rise was in the US, but lots of people in the industry weren't working because it was 9.5 years ago, which seems like an awfully long time ago. But I think we would expect some quite vicious rotation in sectors around that period. Now, everyone tells me markets are very efficient at pricing in future events. I've learned in the last 15 years that that's total nonsense, and actually markets are always surprised by the unsurprising. And I think you will see some quite vicious rotation. So I think actually the banks, having languished for the last few years, even in places like the US where they've had quite a decent credit cycle, I think actually they should start to perform, and other industries linked to the global cyclical economy should start to do quite well. On the flip side, some of the darlings of the last few years, sectors like consumer staples and utilities, I think they could be in for quite a rocky ride actually, and I think people have really bought into those assets on the belief of safety and investing in a rear view mirror. I think actually that could well be the wrong strategy for the next couple of years.
Yeah, I wrote something about this the other week actually, looking at emerging markets, where I was looking at the CAPE valuations on them, basically the cyclically adjusted price to earnings, and they look cheap. And so I asked the question, well, why are people not investing more? Why am I personally not investing more? And I think the answer to that is because I'm worried something bad is going to happen. Whereas something theoretically bad has already happened, because a lot of those markets have lost quite a lot of value over the last 5 years. But there's that concern that they could still fall that bit further. But if you're looking at a nice long-term investing horizon, do markets like that look attractive?
Yeah, I think so. I think that perhaps you're suffering from a case of hindsight bias, and everyone does when it comes to investing. But I think that if you stop with a blank sheet of paper and try and assess where evaluations are attractive for long-term growth fundamentals, and I think areas of the emerging world strike me as still being quite attractive, and frankly let's hope they are, because otherwise the global economy is really going to stutter for the next few years, because ultimately that's where the growth is going to come from. So we look at places like China and India as being attractive markets to invest. A year ago everyone was very bullish on India. Everyone thought that Mr. Modi was going to be the second Messiah. Everyone imagined that India was going to suddenly, for the first time since 1947, become an investable economy. That didn't really happen. And I think actually now valuations there are cheap. The economy there is clearly healing quite quickly. And like China, it has good growth opportunities for the medium term, because these places are getting richer. They're the places where purchasing power parity is improving. And I see those as good long-term opportunities, but no one believes it. And I heard you guys talking earlier about fundamentals and technicals. Well, it strikes me on both fronts, emerging markets could well be quite attractive. Everyone hates them, and it's amazing how quickly they've gone from being loved to being loathed. That often is the prelude to quite a decent opportunity. Picking your entry point is challenging, but certainly in the next 5 years, I think you'll make a lot of money from emerging markets.
Could I just go back to the US? In terms of them hiking up rates in December, there's a huge percentage of Wall Street who've never worked in an environment of rising interest rates. Do you think the market will take it in its stride, and it's now discounting the fact that that interest rate hike is in place in December?
Yeah, I mean, as I said earlier, I mean, I'm always surprised by the market's ability to be surprised by something totally unsurprising. That sounds like a mouthful, but, ultimately, I think we'll have to wait and see. But, markets have started to price it in quite efficiently. The dollar's been strong. US government bonds have been quite weak, aside from the tragic events over the weekend that we talked about, and we talked about earlier. And there was obviously a flight into US government bonds for a short-lived period on Monday morning. But ultimately, they are now starting to price in an interest rate hike, and certain sectors have started to underperform, like the utilities, and the banks have started to show some signs of life. So I personally think the markets are starting to price that in already. I think much, much more important, both for the watchers of your show and investors everywhere, is not when the first rate hike happens, either in the US or the UK. The most important thing to focus on is medium-term rates, both in the UK and the US, and not getting back to the levels that we became used to in the halcyon days of the last decade. decade. Medium-term rates are not going to 5% again for quite a long time, in our opinion. I think in the next 3 to 5 years, you'll see interest rates peak out at around 2.5% in the UK and the US, and that probably remains quite supportive for asset markets. So the reason I wouldn't get very bearish on bonds or very bearish on some of the defensive sectors is because you're just not going to see interest rates go up that quickly, or indeed peak that far up in the cycle.
Presumably, though, when you're looking at bonds, for your investors, you're treading very, very carefully in that minefield.
Yeah, no, I think so, and I think it's important to focus both on the types of bonds you're investing into, the regions where you're investing, and focus upon how long it is to maturity, because ultimately bonds are not like company shares. You always know what you're going to get back as long as that company doesn't default. So there is really, you talked about value traps with regards to emerging markets earlier. It's very difficult to get into value traps in bonds because ultimately you either get your money back or the bond defaults. And I think that if you can select the right part of the capital structure, the right region, and indeed the right maturity of bond, then I think you're in a good place. And we currently have big positions in certain European and US corporate debt where actually yields are really quite high, and actually you're not having to hold bonds for that long to achieve yields in excess of 5-6%. And so ultimately there's opportunities in bonds, but I think you need to eschew the qualities of government bonds, focus on credit-specific opportunities, and focus on the right places. And if you do that, it becomes more of an opportunity set than a minefield in my example.
China, onto that as well. You've been to China recently, haven't you?
Indeed, yeah. I remember some of it. It was a few months ago.
Yeah. And what were your thoughts from visiting China on how the situation looks?
Yeah, and it's always interesting, and it's very refreshing to go to these places, and I'm going to Tokyo next week to really reassess the big opportunity set that we've seen there. But China, I went to with some trepidation, and when you arrive there, you feel somewhat naive about the trepidation you hold, because clearly things are still progressing there at quite a decent lick, and there is growth, and I think the authorities have more of a handle on the situation than people give them credit for in the Western press, certainly. That's not to beat out the Western press, but there is a lot of xenophobic attitudes towards what's happening there. But actually I think if you speak to Chinese people there, they look at the situations we're here with regards to demographics, the debt pile, and the lack of real structural growth, and they think they're the lucky ones, and to a certain extent I agree. And also if you look at markets like Hong Kong, which isn't investing in Chinese commodity shares, it's investing in proper companies, they're cheap. And I think they offer a great opportunity, and you can buy high quality Hong Kong listed companies with good long-term growth potentials and high dividend yields. Those sort of things to me, at a time when sentiment's very, very weak, look attractive, and we have a high allocation towards such markets.
And the US, finally, would you invest? Do you invest in the US at the moment?
I think, going back to Nick's point earlier, you have to be much, much more selective with regards to where you invest because of the whole dynamic of a potential interest rate hike. Well, it's going to happen at some point, surely. But you have to be much, much more sector specific. So I focus on things like energy. Again, I don't do everything on a contrarian basis. Everyone hates it, but actually energy companies recently had quite decent results in the face of very difficult problems, and things like healthcare. So if you're much, much more specific and find things which are going to benefit from the US ongoing economic and structural situations, then I think you can make money. Going out and buying a US passive tracker now, I think would be absolutely the wrong move on a 3-year view.
The easy money's been made, basically.
100% is my view.
Great. Tom, thank you very much for joining us.
My pleasure, thank you.
Richard, thank you. Nick,
thanks, Tom.
Thank you.
Nice to see you.
Join us next time for The Investing Show. Goodbye.